Good morning, everybody. It is Friday, January 21st. And as you can see, we are having a winter storm here on my green screen. It's actually freezing here in Wisconsin. It's about zero, but it's not actually snowing. We've had almost no snow this winter, unless you go way to the northern part of the state, which is where all the snowmobilers are. So today I thought we'd do a Q&A, and given that the market is volatile, and I think that is a good place to start would be the article I just put out on Seeking Alpha. This will go up on fundamental trends as soon as the call is over with. I just finished this. It really talks about the historic market valuations, where we're starting from. So make sure you take a look at this, and you can go through the charts, and what you'll see is that even with the volatility the last couple of months, we are still at historic overvaluations. And that means not just the price to earnings ratio, but the Shiller ratio, Tobin Q, which is a measure of replacement value, and then the reversion to the trend. Not mean, but the trend. So the trend serves as the mean, and we are way up here. This is the most expensive the market's probably ever been. Again, it's hard to normalize for the earnings because of all the lying that goes on with accounting. We might be first, second, or third most overvalued in history. It depends on what the earnings really were back in 1929 and 2000. But as you can see, it's darn close. A typical correction historically would bring us down to right around the red line or below it with an overshoot. I don't think the Fed will allow an overshoot if they can help it, and I think they can. But I do think an approach to the trend line is not unlikely. If you saw my Twitter feed, you saw that Jeremy Grantham once again has said that a 40 to 50% correction is probably likely. So I would keep an eye on guys like that. Jim Rogers is saying the same thing. You need to be patient, as I said in the rare chat today, which I can't play because I'll get sanctioned by YouTube. But remember, you got to have some patience. And that's an answer to one of the questions. So as you go through the valuations, take a look at the Buffett measure. It's the most expensive in history. The Wilshire stock index is another way to measure the same concept. We are way over where we're supposed to be. Again, this implies about, because of where it's valued, to get back to a normalish range, about a 50% correction. And again, we're referring mainly to the large caps, because as we know, the small caps have pretty much already had it almost all the way across the board, except for a handful of larger small caps that hold the index up. And we need to think about what are large caps going to look like going forward. These are the four major stock market corrections in the last little over a decade. You can see the bull market since the Great Recession blows away all the other recoveries, despite the fact that our growth is lower. So this is a chart from Hussman, and what he's saying right now is that we are within the last gasp of the top of the market, if we haven't already gotten there. I think we might have already gotten there. We'll see. If it does go a little higher, on hopium or the Fed backing off or whatever, or COVID suddenly disappearing, again, potentially aliens, it could go a little higher. It can always go a little higher. But if it starts to come down, the spiral effect should be pretty substantial as the millennials that I've warned you about start to trade the other side of the equation. And they start to try to make money on the downside. And everybody's going to try to scare the old men because they're the ones that can be scared. And the institutions and the hedge funds will just sit it out with their big money until they can get vulture prices. So you should start to think like vulture and look at our bottom fishing prices. My bottom fishing prices, which are based on volume weighted measures of relative strength, the money flow index, shaken, and some other factors, have pretty largely been close to shooters. And I think that in the broad picture, shooters Elliott wave has been just amazing. And then right at the point of figuring out the pivot, you use it again. So Well, I'll put up my target boxes and get pretty close. And you have to remember, the first orange line that you see on my target boxes is when I put in the target. So in this chart, this is EMQQ. I started talking about a price down, under 50 way back here. Now, this line was higher. It was up around 50 for a while, and I had that back in here. So this is the most recent buy zone, which I talked about in May of 2021 when this was still in the 50s and over 60. So we're down towards 40, and Shooter is saying a price around 38 could be the pivot point. I worry that we get down closer to 30, but we'll see. China is loosening their finances, and I think that China stocks, commie stocks as a basket, I wouldn't buy them individually. I get wishy-washy on Alibaba just because they're such a huge cloud company. But this fund is about 10% Alibaba. So if I like the rest of the emerging markets, EMQQ is something I'm going to look at. If I don't like the rest of the emerging markets, then I might just buy a pure commie fund and get K-Web down in here, which we need a chart from Shooter to see if we're ready to pivot. Is this pivoting already, or 1, 2, 3, 4, 5? Does it have one more leg down? I think it makes sense to me that it has another leg down, but we'll see. All right, so I said you can ask me some questions. So the first one over here at Fundamental Trends, and there's a bunch of questions in the chat as well, was somebody wants more explanation from Shooter about his trading method, explain the duration and size of trades and rules he created. He actually has a trading manual, essentially, that's linked at the top of every article. So if you go to Rare Investing, which is the only place you can get his stuff, he has a user guide. So you can just go through there, right? And he talks about it all. Now, I will also say, you need to read a couple of Elliott Wave books. It'll take you a weekend each one, but you need to read a couple of Elliott Wave books. I will link those. I'm finally going to get my book list out, which has been sitting around for a year. Obviously, I don't put a lot of value on you linking to those articles and making me $1 for buying the books, but I think it'll help you to have the books. There's 2 Elliott Wave books I like out there. Shooter has linked a particular YouTube page that has a bunch of great videos. No point in him redoing them, but he does, he explains things pretty well in these little off takes that he does. And you can get these links in the chat. And then after 2 or 3 days, I usually make them public, at least for now. I'm making them public after a couple of days just to get a little PR out there. But, he's been pretty spot on. So if you are a swing trader and you're trying to make a trade that'll last a few days to a few weeks, this stuff is gold. And then he's doing some longer term Elliott Waves, which have really largely overlapped my buy zones. So it's nice to have the confirmation. More questions over here. And this is why I was playing with the bar chart before we started the video. So you have the question, will the leaders over the last couple of years be the leaders of the next couple of years? The answer is usually yes. It's usually smart after a correction to buy the best companies that perform the best before the correction. And that's why I keep an eye on, and apparently my credit card expired, so I don't have my screener overlay in here. And normally I would screen for stocks over $500 million. The 2-year returns are what you generally look at. These are usually the best ones to look at. And you can look at 3 years, but 2 years is usually, to me, screens out a lot of things that have changed if you just look at the last 2 years. And you can see that most of these stocks will probably be leaders again in the next couple of years if they get a strong enough pullback. You can see that the 6-month change on GameStop is already down almost 50%. That's something that I told my nephew, who I hope he listens to this. I told him this was going to happen. So it's down 50%. And the question becomes is the me malicious future with GameStop? It's not a hard and fast rule that these will be the ones that do the best. but usually it's a place to start. So Riot Blockchain is one that I'm looking at. Ametis is one that we're looking at, and I just got the editing done of the interview with the Ametis CEO, so that'll go up probably Tuesday. The interview with Sean Stein-Smith on cryptocurrency will go up on Monday. So we'll have 2 interviews next week. But through here, we'll find companies, Novavax, Tesla. Right? If Tesla gets down to that 400 or 500 range, which is what I think the ultimate bottom could be, you have to buy Tesla at that point, right? Because now all of a sudden it's worth $400 or $500 billion and probably going to go back up to $1 trillion again. I think the $1 trillion valuation on Tesla right now reflects all the good things that could happen over the next 5 to 10 years. It comes down in half. Now all of a sudden, I've got a stock that's probably going to go up, probably going to double for me. And if it catches the wind and the imagination and the commitment of the millennials, now maybe it becomes a $2 trillion or $3 trillion company. They would have to really perform well in the solar and battery space for that to happen. But that's going to take a lot of execution, so we'll see. In any case, these are some of the names. You also get some spectacular losers off of this list, and I would suggest that a lot of the oil-focused companies will be on that spectacular loser list in the future. If you took a look on Bloomberg this morning, we had a surprise oil build, inventory build, and we had a massive gasoline build. And that's because, again, coronavirus is going to be with us for a while. The government's giving up on getting rid of it. It's going to take years for it to go away because we have people at this point that I believe until they get really sick, they're just not going to get vaccinated and they're not going to wear masks because it's a freedom thing for them. It doesn't matter if it prevents them from getting somebody else that's next to them sick. So, I think we just have to resolve ourselves to the idea that we're going to have some bad news from time to time when it comes to COVID, probably for the next several years would be my guess. Remember, I told you that we'd probably have 1 million people die based on the way that we were doing things a year and a half ago. And sure enough, we're closing in on 1 million deaths now. I'm just trying to be analytical here and skip over the ideology and the emotion and the finger wagging. In any case, more questions. Generally, are there some stocks that are ready to cost average into? So when there's heavy downward momentum in the markets, the answer is no. Again, and I don't know, I don't know if you're new to the service, but scaling in is done at significant technical points. It's not just because it went down a little bit, right? We don't want to get into the martingale style of investing. What does that mean? So martingale is a way of just the easiest way to understand it is blackjack. Is you lose a hand in blackjack for $10, so you bet 20 the next time because, hey, I'm going to win eventually. And then you lose. And then so you bet 40. Well, if I win this one, I'm even. Then you lose and you bet 80. And then you bet 160. And then you bet 320. And then you look in your wallet and you're like, oh, that's all the cash I brought. And now you can't double your bets anymore. So you walk away from the table and sure enough, 4 blackjacks. Boom, 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 boom. So when you scale in, you do it slowly and at very wide price points. And there has to be a technical reversal potential to be able to do that. So we want to make sure that, it went down $1, so I'm going to buy it. It went down $5, I'm going to buy it. It went down 20%, so I'm going to buy it. No, look for where the support levels are and what the relative strength index and money flow index is. There a divergence technically? So all these technical indicators tell you when things are roughly going to turn. They don't work every time. Sometimes you have to go to the next one, but they are the spots where you buy because those are the more likely spots where things are going to turn. And there's a lot of wisdom in just wait till things start to go back up, right? Will Rogers, what do you buy when the stock market? I buy ones that go up. And that's something that the millennials have really embraced is I won't buy anything that's going down right now. And if they miss a little upside, they don't care because then they all jump in there and they push it back up. So the thing to keep in mind when you're scaling in is far apart. And I've been moving towards because I've always been a pivot investor. but it's not worked as well in the QE age. So I'm moving more towards wait for it to start to go up after I have my initial position. Bottoming of psychology, I think I just kind of covered that. I think you have to think like a millennial. Their psychology is going to drive this. They're the ones that are going to mark the bottom when they start to put a lot of money back into the market. When they switch from calls to puts to back to calls, that's what you have to follow. So you see me put up the put to call ratio. You see me put up the FINRA leverage ratio. When FINRA leverage crashes, that would be a great time to start buying. So that we have a whole lot of cash on the sidelines for us. Be careful, be patient, and it'll eventually come to you. Let me check for some more questions. Yeah, somebody basically asked about the momentum. Yeah, just be careful with momentum. If something's heading down, you can wait. Even if the fundamental side says this is cheap, like On Track. So somebody asked about On Track online today or yesterday, and I did post a reply. So On Track has a filing that talks about loosening some of the restrictions that they had in place to preserve their carry forward tax losses. And essentially what they're saying is we are willing to allow investors above 4.99% now if we can get the right deal. So On Track has a major new partner on the software side who happens to be a customer. We think it's Salesforce, but we're not positive. And they just put out a product that they've been talking about since March, and it's gaining a lot of traction. So On Track is willing to take on a big investor at this point, is what they're saying. So that makes you think, is Salesforce or whoever this company is, it might be Microsoft, but I think it's Salesforce, going to invest in them now that they're helping them develop their app and take their app from, take their service from being very focused to very wide. So what On Track is going to do, and they've been talking about since March, if you read any of their filings or just take a look at their presentation, is they're going soup to nuts, top to bottom, treatment of mental health issues and the corresponding impact on health issues. So, this app could be a big deal. They already have the network of providers in place. I think that the transition from focused at the start on just big groups to hospital groups and companies and everything else is going to be pretty massive, because I think the mental health market is incredibly underserved and is something that is ripe for technological disruption. I thought that the stock was a bargain after it was down 70%, and it went down another 70%. So now all of a sudden you have a stock that's down 90 some odd percent off of its high, and you have to ask yourself, what the heck is the right price? Well, based on the shares outstanding and what it looks like their traction is on sales, and the fact that they're so heavy in cash all of a sudden, $20-ish seems to be about fair value, and they're trading at 4 or 5. That's one that I think is the rare one where you could scale in here to lower your cost basis, because your cost basis might be in the 20s right now with option premium. And if you can cut that in half by doubling your position, then I think that makes some sense. You have to mind your asset allocation, though. None of these small cap stocks are worth more than 1 or 2% in a portfolio in most cases. You could go up to 3 or 4% for a hot minute while you ride it up. But eventually, you have to decide, okay, let's say On Track starts to rally and it gets to 20. Do you sell some? Well, I think you look at the technical indicators, because at that point, it's just fair value. And things with momentum tend to go above fair value. So then it gets to 30, then maybe it gets to 40. Now you have to start doing some thinking. Okay, if it went back to 20 from 40, how would that change my investment outlook? And would it change my life, if I lost half of that money? When I was in Exact, I rode it from $1.65 into the 30s. I sold most of my stock and options, but I kept a position. When it got to 20, I started buying it again, and then the damn thing went to 6. So I loaded up at 6. I started selling it again when it got into the 40s. I pretty much got out of it in the 70s, and it was one of those rare cases where you get 2 10-baggers by playing the waves. And there was a disruption in the whole pattern because of a regulatory thing. So when you invest, and scale in, there's just a lot to it, right? It's not just it went down, so I should buy more. It went down, I have to ask why, and is it still going down? And what does that do for my cost basis? If you double your position after something's gone down 50%, that could be a pretty good idea. But if it went down 10 or 20%, how does that really change your cost basis? It's a buck or two, who cares? More questions. You prepared us for this down market. I raised my cash balance as you suggested, and now we wait. Yep, now we wait. Somebody asked about a company called Proterra. I'll put it on my list. I don't know anything about it. Someone mentions Bluebird. I don't know anything about that. It looks like these are EV stocks or charging stocks. Bluebird is the charging one, right? I don't think that pure EV charging stations are going to be where the big money is. I think the big money is going to be in what surrounds the EV charging stations. That's why I like Travel America. That's why I like Berkshire Hathaway, because they own Pilot and Flying J. That's why I thought about buying a truck stop, and I still might. So we can take a look at this stuff and ask these questions. But a lot of companies that are capital intensive will have a hard time eventually. And the growth of home charging stations, which is, I don't know if this company does that or not. I think eventually solar on the roof and charging with some sort of a battery in your house as well is the future. That future is going to take a decade to become mainstream, and then probably another decade to really get it everywhere that it can be. So we're talking about a 20-year process here, which is why, even though I'm bearish on oil, I get why people keep trying to trade oil. I can try to trade other things and think I make more money. But people who are married to oil, hey, if you do a good job, you can make a ton of money. Shooter can do it. His mentor, Dale Pinkert, is really good at it. So there's a lot of people out there can trade oil. I just will tell you, when you trade against the pros, you better be damn careful. And now you got to throw in the millennials who are really good traders. So trading is not easy. 4 out of 5 folks should not do it. But if you're in the 1 out of 5 that has the stomach for it, you're willing to do the reading, and you're willing to keep up, I mean, it'll be a part-time job for sure. You actually can make a lot of money faster than just the buy and hold and the position trading. But I've averaged, because some of the home runs, I mean, my average is well into the 20s, if not over 30%. It's just, you have long periods of waiting, right? The old military thing, hurry up and wait. There's a lot of that out there. All right. So somebody says, Square, I've been continuing to lower my limit price order below bottom fishing price, now at $110. We'll take a look at that. I'll put that. I'm going to do a lot of charts this weekend, and I'm going to pull in Shooter's charts too, because he's been archiving them over at Fundamental Trends for us on his weekly piece. If you see charts that he posted in chats, he's got a whole bunch of them. Which Shooter, I love you for doing this. It's just adding to the long list of why I love Shooter. And you really should be watching his videos when you can. And pretty much you should watch them all. And they're short. His are only like 10 minutes, so they're great. I got the sexy hat in New York with my kids. 2012, maybe? I think 2012. All right. Bitcoin, somebody says. I'm not into crypto, but what the heck? Well, the article on Monday is going to be titled, Bitcoin is going to 100,000, which I think is a great time to put it out since everybody's negative on it right now. And then I will put the Sean Stein Smith out there. I think that the low end for Bitcoin is between 20 and 30,000. Shooter said today 32,000 is a target. So as I've told folks over and over and over again, click on Coinbase, open an account, put $100 in. You get 10, I get 10. And, I think that you should just start doing their learn and earn. They have these videos, and once you have an account, they will actually give you some cryptocurrency. So they'll have you learn about Ethereum, and you'll get $1.50 worth of Ethereum. They'll have you learn about Solera or whatever, and they'll give you $2 of Solera, and it's really part of their marketing campaign, right? It's marketing budget for them, and what they want you to do is come on here and open an account, and you could use several others. I use Coinbase because they made it easy for me and they gave me free stuff and my old links, and put in like $10,000, I would have got like $500. I'm just doing the $10 thing, so you get $10, I get $10, and I just want you to use Coinbase or something similar. If you do the research and you like something else, that's great. But Ethereum and Bitcoin are both going to be very good into the future. If you want to read a little bit more about it, come over here and read the crypto trade shots, which through free sample number 7 are free. And after the 7th edition in a couple of weeks, this will all be behind a paywall. You have to be a member of Rare and buy this on the side too. If you're a margin of safety investor, I will come up with a way for you to get crypto trade shots without having to give up margin of safety. I just have to see how the technology works and figure out a way to do that. I dollar cost average into Ethereum every month, and I just transferred more money over to Coinbase on the idea that I would buy a pivot low range price for Bitcoin. So if Bitcoin gets to 32,000-ish, I'll probably buy some. If it gets in the 20s, I'll buy a whole bunch. The reason that you have to understand what's going on in cryptocurrency is because it really is the future. Blockchain is going to power everything from stores of value, which is Bitcoin, to digital contracts, NFTs, and NFTs that aren't just used for funny pictures on the internet, but for building real estate. Somebody just built a $200 million golf course or funded a $200 million golf course with NFTs. So anybody who bought the NFT got a membership to the golf course and part of the investment. That is what I have talked about wanting to do with a couple of particular different types of properties. So we'll see. And I actually have moved a step closer to getting that funded because I have talked to a couple of 9-figure folks who I'm on good terms with. Would you hold Amazon, Facebook, Microsoft, Google through this upcoming correction? I think that you can trim your profits. I think I've been saying that for months. And it is not something that I would necessarily do in a taxable account. I don't think there's any point to selling this stuff in taxable accounts because, they might not drop 20%. They might drop 19%. But even if they do drop 20%, which corresponds to your capital gains taxes that you'd have to pay, you're just going to buy it back anyway. So I think there's a reason to sell these in an IRA, and not all the way out, but definitely take some profits and then set limit orders to buy it back, and don't gut it out, right? I mean, just set in, at this technical level and this technical level, I'm buying it back, and I got back in cheaper than I sold. Don't try to bottom it because then you might miss it, right? So just make sure you're getting back in and create some space between where you sold and where you're buying here and here. And if it goes down here, so be it. You still did better than having held it. Hodled it. All right. Yes, I will figure out a way to get crypto for the multi members. Let me see here. Somebody says shooter is awesome. I agree. Where did you get sexy hat? We covered that. I need some sunshine. Yes, I will be in Las Vegas from June 11th to the 23rd, by the way. And I don't know when I'm going to Southern California and Northern California. I suspect in the fall, but I might try to sneak in May. I'm supposed to go to Vegas for the money show. And I'm kind of ambivalent about doing it live because it's just not as effective as online. Oh, yeah, I knew I saw those. So right now I have a limit order on PBW at 50. Wow, look, it's down 651 today. So we're going to have to do a shooter consultation on PBW. And I think he did that in the last week for us. So I'll look it up. Well, I think he said that it could go all the way down to like 38 or something. So that's way down here. So this chart isn't dissimilar than the S&P 500. So I just want to show you the S&P 500 here. When you take a look at the S&P 500, this is where the market started to roll over and we were a little worried. then they started QE to bail out the repo market, and we got that rally. And then it came back and tested. This price range, basically the bottom of my buy zone, about 340 or so on the S&P 500, is where a lot of top technical analysts think this is going. And they don't think it'll break down below this jitterbug zone here and here because they think this is an anomaly. Here's the problem. When you go back, how far back? Way back. Name that song. What you see is that the QE rally has been obnoxious, and it accelerated out of this flat period in 2016, Jay Powell age. It's not impossible for it to come all the way back down here to this 2015-16 level. Why? Well, the answer is, and I don't think it's going to, so I set mine out there, is I just think there's too much money out there. It's basically bottom line. There's too much money. So at some point, people come in and buy. So I think this top of January 2020 is probably now the support region. But we're going to have to keep an eye on it in real time because this pattern here, lower lows, 3 lower lows, that's called a broadening megaphone pattern. And many people would argue that this was the bottom of it. But it doesn't have to be. It could definitely come, have another low down here, which would correspond with, if people who've been with me long enough know that I've been calling 2015-16 the base level. I think the stock market never goes below 2015-16 levels just because of monetary inflation. We'd have to try to destroy everything for it to go below about 200 on SPY. But prices in the 300s, I think, are all in play, even the very top of the 200s. But I would buy into the argument that this was the bottom of the broadening megaphone pattern. So lower low, lower low, lower low. I would argue that that was the bottom. And this correction, I think, only gets to here, right in here. But we'll see. Again, I'm in camp transitory on inflation. I think that inflation is mainly supply chain and oil driven. Oil's about as high as it can go without a war. And supply chains are slowly getting better. And I'll just tell you, as the supply chains move back to America and people start to recognize what automation can do, man, there's going to be a lot of people working 35-hour weeks or 4-day weeks in the future and making as much money as they make today. And we're going to have more food security, although we're good with that in America. But we're going to have all sorts of financial security because I think we're going to start running budget surpluses at some point. And I know the people look at me like I'm crazy when I say that, but there is no reason why the United States can't run $1 trillion surpluses year over year over year. And with the United States providing more of our own stuff, that won't necessarily be good for a lot of other economies, in particular China. And some of those export economies are really going to have to think through how they do things. And we're, from a geopolitical standpoint, we're going to have to figure out, okay, how do we keep our allies in Southeast Asia and Eastern Europe with China and Russia breathing down their neck, and we're not buying as much stuff from them. One of the great things about the dollar is that it's allowed us to buy a lot of stuff from a lot of places, and that makes them toe the line on security issues. So we'll see how that all rolls out over the next 20 years. My guess is that the way it goes, and then in the short term, the dollar rebounds in a little while. I might go down for a little longer, but I'm a dollar bull. I've been a dollar bull since 2012, and actually before that, but I started publishing out in 2012. And of course, we got a huge bull market in the dollar since 2012, right? I mean, it's much higher than it was in 2012 against the other 8 currencies that it gets measured against. And in the very short term, can it roll over and then head back up? Absolutely. That's just part of the wave system, right? So you'd see a correction. You have your little waves within the bigger waves, and then the zoom. I think there's a very good possibility that the dollar ends up in a new zone up here in the 2030s. How does that impact the market again? You get periods of correction when the dollar gets strong, when it's becoming stronger in particular. Once it's in a trading zone, it's not that important, then things normalize. So rates of change, if you ever read Eric Bajamarian's articles on Seeking Alpha. He's got it nailed. He's a good kid. And I tell you what, he's got it nailed on rates of change. Rates of change, changes in directions. When a curve starts to bend up or when a curve starts to bend down, those are the spots where prices change. It's not because it gets down to here. The change occurs on the rollover or on the bend up. If Russia invades Ukraine, will that be good or bad for oil price? Does Ukraine produce any oil? I don't know. I don't think it matters. And I don't know that they're going to invade anyway, because Biden's advisors are clearly, and I just resubscribed to Foreign Policy too, because they gave me a deal. But I was reading about this. I think Biden, he started to pivot a little bit because he was being wishy-washy. The thing that you have to watch for with Ukraine and Russia is if Russia comes over that border, it might not just be economic sanctions that we're looking at. We might fire on them. And frankly, I think that that's what we have to do. I think that if Russia invades Ukraine, that we should be providing fire. And we'll see. At that point, you're basically telling Putin, look, there's a line and you crossed it. And do you have a regional, I'm not saying that we send in the army, but, it's real easy with drones at this point to basically just spray advancing troops. So we'll see what happens there. I don't think Putin's going to do it. I think Putin's going to extract what he can, which will probably be an agreement that Ukraine doesn't get admitted to NATO anytime soon. If it were me, I would, in the middle of the night, admit Ukraine to NATO. That's what I would do. But, that's just me sitting here in a snowstorm. With the $20 billion gigafactory that Intel is building in Ohio, will Intel be a 10-year 5-bagger, 10-bagger or more? I don't even remember that they're doing one. Are they doing one in Ohio now? I didn't even see that. I knew that they had the couple in Phoenix. I am super bullish on Intel. I think that it is one of the best dividend growth stories out there. They have a fortress balance sheet. I think that is a stock that's going to end up being like Qualcomm and kicking out a 4 or 5% dividend. They just announced it a couple days ago. Oh, well, see, who was saying they wonder why they're not building something closer to the water? I know a guy. Oh, yeah, this guy. I wish it would have, damn it, I wish it would have come to Southeast Wisconsin. No, that's going to be great. Where is it? Is it going to be near Cleveland? It's got to be relatively close to Great Lakes water, right? So, or they put it near Cincinnati. Columbus. Yeah, Columbus gets Great Lakes water, don't they? I think that that's spectacular for Intel. If we can get a deal on Intel, that's a stock I've been dying to get into. Well, I typed wrong. NTC. There we go. Intel Corp. Yeah. It doesn't want to come down, but it is today. Oh, calling shooter, another shooter question. I might buy the top of the buy zone here because I don't know that it gets all the way down here. I think a lot of people are starting to realize what I've been talking about for the last, since they announced the new factories in the Phoenix area, that Intel's going to be a big deal. I think for sure it's going to be $100 stock. So we'll see how far it goes above that. But if you're a dividend growth investor, this is one of the safest stocks you can buy, right? Semiconductors are everything. SunPower down 16% today. 14.15 is the price we were looking for. Oh, yeah. Tell you what, these clean energy stocks, but I'm going to do a lot of work on these over the weekend. I wish Shooter was on. If you don't own any PBW or SunPower, I don't think it hurts you to just open up a starter position and then build from there. If it starts to rebound, you can add to it. If it falls more, you can add to it. But if you don't have a position in SunPower or PBW, I think that you can, even like today, just take a teeny tiny nibble. Or if you already own some, I think you can sell like $15 cash secured puts. And then once you sell the $15 cash secured put, don't go crazy when it goes to 12, right? I guess theoretically you could get down to 10, 11, 12 here, right up there. My bottom fishing is always just a little bit above what is really bottom fishing, because I want it to be on your radar a couple dollars right above where it could go to. All right. Cannabis. Yeah, CNBS is down. Right. If you don't have a position, buy some weed. YOLO. I have orders in it. 10 to buy more. I already own YOLO. I might buy CNBS just so I have both of them, right? Because CNBS is managed, YOLO is an index. It's pretty sexy. That is pretty sexy. Yeah, buy it. If you don't already buy it, because the upside on cannabis is way above where it's been. I mean, the upside is way up here. The revenue, people see this chart and say, oh, go to here. No, the revenue generation for these companies, especially the ones that end up being the winners in the brands, which is what this guy's trying to pick out, Seymour's trying to pick out, the revenue generation, and you're talking, Philip Morris type returns for a decade. And, I'm talking 1960s Philip Morris returns, right? So if we take a look at, I don't know if the chart will go back that far. Yeah, because they split up. Oh, I don't know. Yeah. What's Altria symbol? Mo. Oh, yeah. I mean, you could see a chart like this on these cannabis stocks. That's a 10 bagger, right? This is what the cannabis stocks can do over a decade. All right. Yeah. I tell some jokes. They're not good jokes. My son is actually performing. He has a show on Monday at the Safe House in Milwaukee. Yeah, tan. I haven't charted this in a while. Oops. Wow. Look at that. So when this is way up here and coming down, I flagged this price level. Look where it is. Yeah, my charts are all right. Well, I said 60, but it was 100. We're almost there, aren't we? Yeah, there's going to be a lot of charting this weekend, folks. This is one. So like tan, because it's just solar, right? It's going to be more volatile. Well, I mean, based on the old charting, this is this is really playing out, isn't it? Yeah, for a year I just got lambasted for talking about stuff coming down this much, and here it is. I think we're really close on this one. We're gonna have to talk to Shooter about pivot points. I've seen people smoking weed in a ton of movies. Usually, you have the edibles and the vapes, right? Somebody says you can't compare cannabis use to smoking. That was cultural and addictive. You're wrong. You won't see movie stars smoking joints or eating edibles in the movies. Are you kidding me? It's already happening. Yeah, you got that one wrong, Ham. The reality is that cannabis is taking the place of alcohol. That's comparable. So the comparable is alcohol. There's no doubt about it. Somebody says cannabis is more addictive than documented. Yeah, I don't know if cannabis is addictive like alcohol. Maybe, I don't know. But I think it's something that a lot of people do before bed. I mean, like in Vegas, I'll have an edible just because we're there. Not really my thing. I've never liked smoking anything. Just don't like it. But yeah, psychologically, it could be. But cannabis is the one right now that people don't want to drink. They don't, want to be in bars in particular. Those businesses are still getting beat up. Friend of mine that owns one of the most successful bars in Milwaukee is selling it. In fact, he's selling 2 of his bars. And the last time he sold his bars was 2006 and 7. And then they went into foreclosure and he bought them back out of foreclosure. He's selling again now. Yeah, the world's changing. So I don't underestimate these cannabis stocks. I think they're going to get a lot of revenue that was going to beer. That's why you see beer companies adding cannabis to their beer now. All right. If I've missed a question, I apologize. I think I went through everything. If you're on right now and you have a question that I haven't answered, slap it up now and we'll try to get to it in a couple of minutes. Otherwise, I am once again going to help my 72-year-old buddy. the preferreds on track. I kind of told everybody not to bother with those, but they're going to pay them. I mean, I think that it's a way to avoid some of the common dilution. So, I mean, I guess I wasn't a big fan of them before, but I haven't looked at them. I think that if you wanted a slightly safer way to get into on track right now, go ahead and buy the preferred, but you should have a plan for switching to the common at some point. Pretty much, I haven't looked at the puts on track. Give me one moment. Probably $4 puts, right? Oh, wow. It's down to 354. So with on-track, if you don't own any, I think you almost can write a $5 put deep in the money. And if you do own some, maybe the $3 puts out of the money. I think that's probably the way I would look at it. And what expiration for on-track looks like May. Yeah, looks like May. Anything else? Kazoo. I think Kazoo is a screaming buy here. I'm telling you, some of these companies that the market is just literally, I mean, lack of a better word, shit all over. I mean, it got down to the bottom fishing, got all the way back up here, and then just elevator drop, right, for the last few months. I'll just talk something about the SPACs in general. A lot of these SPACs, they're not trading for book value right now. They're trading below book value, and they still have growth. I mean, you're basically getting these companies for free against not the book value, but the cash value. Some of these companies are sitting on as much cash as what their market cap is, or darn close. So you're getting the businesses for nothing. I mean, they just have to have really bad business models to not go up by triple or quadruple in the next few years. So if you held off on buying these SPACs, then you did the right thing. But I think that these prices that you're getting, these sub $5 prices, these $2, $3, $4 prices, just take a look at what they're sitting on in cash and then say, okay, the company's basically free. Can they do anything to stay in business for the next few years? Because if they can, they're going to do really well. So Black Sky, Spire Global, Kazoo, you go right through the list, and it's just, this is blood in the streets, and it's hard to buy when things are bloody, right? Grosses us out, makes us feel like, oh my God, it's dying. So that's the question you ask: is it really dying? Right? Did it fall down and it's going to get back up, or is it really dying? And if it's not dying, you buy, you hold your nose, right? You're so, I'm going to buy it, and 2, 3, 4 years later, you look and go, wow, I'm really glad that I got some gumption up and I bought these. So, most of these are actually at scale. The SPACs anyway are pretty much across the board at scaling in levels, right? Because up here, bought it at the orange lines, and now you're way down here. This actually changes your cost basis, right? If you buy here, it's not really changing your cost basis much. But way down here, it's half. So you're going to lower your cost basis quite a bit. APPN, I don't think I've looked at this, right? So we've seen a lot of charts that did this, right? So the question I think you have to ask is, are we closer to the beginning or the end of the correction? And I think the answer is, at least from the small caps up, right, at the SPAC level and the small cap level, we're probably closer to the end of the correction than the start. As you move up the market cap structure, they're closer to the start of the correction than the end. So it's an inverse sort of thing. Is the smaller the company, the smaller the market cap, probably the closer to the correction being over with. And these are usually the companies that come roaring out in the next cyclical upturn. So I would take a look at those. And then at the high end of the market cap range, your QQQ7, right? The 7 QQQ stocks that are half of the S&P 500's market cap. Those 7 stocks are super high quality, with the exception of Tesla, which I think is probably getting there. They're the ones with the most downside if they don't execute. The business with the least amount of moat, right? Tesla is the most vulnerable of those 7 big stocks, which is Apple, Google, Amazon, Facebook. Who did I not say? Apple, Microsoft, and NVIDIA. So those 7 big stocks, Tesla is the one that's got the least secure business model. But when they come down 20 to 30%, the rest of the large caps will fall because the SP 500 ETFs will start to get sold. And then once that selling is done, that's it. That's the end of the bear market. I think we'll probably see a typical wave structure here. There'll be a bounce at some point, and then you'll have to figure out what to do. And then there'll be one more leg down. I still think the end of the year, if the year is negative going into Q4, then Q4 will probably be pretty bad. If the year is about even, then you'll just get a bifurcated market. Some go up, some go down, which is what I'm calling the great divergence. I think that there is a long period of the zombies getting killed over the next 6, 7, 8 years because the Fed's not going to bail them out in the bond market again unless there's a catastrophe going on. And I just don't think that is going to happen. I think that we have put ourselves in a position monetarily, and it looks like Build Back Better is about to get done. Half as big, but still, they're going to shorten time frames to make it look smaller. They're just going to have to go back and deal with it again in 4 or 5 years. But there's so much cash out there, and so much innovation, and a lot of people out there like me who are looking to invest private money that is tied to the sustainable smart everything world and blockchain and things like that. I just don't see the zombies getting rescued again. This is your chance to get out of companies that have secular headwinds. And if you don't do it, you can't say I didn't tell you. I might be a few years early, but why play with fire? I mean, if you take a look at the clean energy indexes, Q Clean and PBW, ask yourself this question. If it's good for oil, isn't it better for clean energy? I think that's a no-brainer answer. So why screw around with oil? Because anything that's good for oil is good for clean energy. And there's even more things good for clean energy, like government policy and where all the institutions are putting their money. Why swim upstream just because the current isn't very strong? Because eventually that current's going to get stronger, and it's going to be hard to predict. How does passive investing play into this? I don't think most QQQ investors panic because they picked QQQ subjectively versus SPY. I think SPY sells off because most of those people, that's just the choice they had in their 401k or what Vogel told them to buy. The reality is that QQQ is a better index than SPY. And when people panic, the nature of the SPY investor is to be less informed. And I think that they're the ones more likely to sell. I had somebody quit margin of safety and say, I'm just going to buy an S&P 500 fund. And I can almost think that's just a dig at me. I'll tell you what, the S&P 500 twice or 3 times in the last 20 years has outperformed QQQ, other than the dot-com bust. So 20 years ago, it did one time. I think that if the SPY investors do panic, that is the circumstance where we can go below January 2020 levels. That would imply that we can get all the way back down close to March 2020 levels. So in those 3 months, January to March of 2020, the first quarter of 2020, we either land at the top of it or the bottom of it, or somewhere in between, right? But that's really where things can get to. And we don't have to get all the way that low, right? I mean, maybe the Fed does what I think that they should do, which is announce the end of QE next week, say they're raising 0.5 point just to get the system back into equilibrium, and then they're going to wait and see and be data dependent. If they say that, the market sells off, and then a month or two later, whenever the next meeting is, I think it's March. If they don't raise the following meeting, they can say, hey, it looks like everything's working. And then, hey, then maybe the market does have a big leg up. Just have to wait and see. And I could be early on the whole inflation ending thing too. I think inflation is back down to a 2 handle in 2023. And I think by the end of this year, it's a 3 handle. So, what could change that? I guess something bad in China, a war in the Middle East, or something that causes oil to go into the hundreds, which, I think it's going to sniff 100 just because I think the traders have that kind of power for a hot minute. It won't stay above 100 unless there's a war. And it looks like the Iran deal is going to get done. Although the mullahs are crazy. I thought that there would have been a war 4 years ago. But the mullahs are crazy. And maybe they double dog dare us. And if they do, they're not going to be happy with the hellfire that gets rained on them, in which case price of oil goes up. Inflation, a 3 handle. Can you say that again? What does that mean? 3% inflation instead of 7%. 3 point something, right? 3 handle. Inflation is about 7% right now is what they're saying. I think it'll come all the way down to 3 something. But this year, 2% 2 something next year. And again, oil is the biggest wild card, and then China after that. I think you should really think about China a little bit. Are they just stimulating for the sake of stimulus because they want to grow, or is there something really wrong? I don't know. We'll see. Yeah, year over year, comparables have a big impact on inflation. I wrote the article. Inflation is transitory, but price levels are permanent, right? It's in here. The Fed is reloading its bazooka, which is why I think they might shock the system here short term. Here, inflation is transitory, but most prices are permanent. So what that means is we took a stair level higher on prices. The prices aren't going to go back down on everything. Certain things will start to go back down, but I think wages are real sticky. I think rents probably are the thing that come down as housing gets on the market, and that'll be a big impact on inflation. But I think it's going to remain like I went to Costco, and the tenderloin there was $18.99 a pound. I've never seen it that high at Costco. My local I go to a nicer grocer over here called Sendix, and they have sales on red meat in the summer usually because they have some deals with some providers. And we were getting tenderloin for $5.99 3 years ago. Well, now their sales are $9.99, and the regular price is $15.99 or $17.99 depending on the grade, right? So yeah, a lot of price levels. I mean, I don't expect to pay $1 for a loaf of bread ever again either. So, there's certain things out there that the prices are going to remain high. I think a lot of food is in that category if you're partial to whole food. Not Whole Foods the store, but just better quality food. That's why if you're building a house, build yourself a greenhouse on the south side of the building, and you'll be happy with that. All right, I'm getting winded. I think I got everything. I'm going to do a lot of writing on Sunday morning and Sunday night. Got to go pick up a barn door for our bathroom remodel here on Sunday afternoon. Saturday is Packer Day. Go Pack Go. So I probably won't get much done tomorrow. Probably work a little bit tonight. So got interviews coming out next week, and I am going to release a series of articles that kind of really break apart the plug and play. Oh, somebody asked earlier in the week, I don't understand the VSL. Why should I not be looking at the VSL? Why should I be looking at the plug and play? The VSL is a watch list. It's screened, not always up to date on 200 companies. The plug and play are the 50 or so companies that this quarter look like we get a good opportunity. So focus on the plug and play stocks. If you want to glance at the VSL, that's fine. But that's mainly for quick glancing, just see trends and take a look at a chart. But focus on the plug and play. Those are the companies that I think have the biggest advantages, best risk to return possibilities, and in most cases are close to a buy price, or I think in the next 3 months could get close to a buy price. So since I think there's a first quarter correction, and as I said that back in December, all the stocks on a plug and play, I think the first quarter could potentially hit their buy prices, get into the buy zones. So that's what I'm looking for. I think there's a lot of zombies out there, and it's every industry, including tech. The companies that adopt fourth industrial revolution technology are the ones that are going to do the best. The companies that don't have the money to spend on it or face some sort of secular decline, like I think I don't like Altria and Philip Morris. I just think that I think they're lucky lately. But if you take a look at their long-term charts, they just can't overcome where they are. And the pivot is going to be hard. The execution is going to have to be perfect. I mean, they're just going to have to get lucky and run a string of winners. And like in poker, I can get aces in 5 times in a row, and I'm only going to win 3 or 4. And there's days when I'm not going to win any. So I think that Philip Morris and Altria are not playing with aces. I think they're playing with like an ace jack. And I have a special nickname for people that overplay ace jack. It's followed by a George Carlin word. And it's just not that strong of a hand. And in fact, you're going to lose more than you win. So I think that is the way to think about a lot of these things. So I think a lot of consumer staples stocks are zombies. They haven't made a lot of money for a long time, and it's getting worse. I think all the coal are zombie companies. I think coal is just going to keep on falling apart, especially once India and China, once the demand curve in India and China goes from flattish to turning over, coal's there's going to be everybody in coal is going to go bankrupt. Everybody. The governments are going to have to absorb those companies and clean them up, clean up the land, and turn them into parks. I'm not even joking about that. I think that most of the airlines are zombies. I think Delta is a potential outlier there. But I think some of your low cost carriers like Spirit and Southwest, I think they got problems. I think that American and United have problems. Like I said, Delta is the only airline that I'd even consider buying on a big correction. And, you go industry to industry, and I think that is what you're looking at. I think the cruise lines are in trouble. I don't know that they ever come back. I have not seen a lot of love from the millennials. I think the millennials would rather fly to a destination and then sit on that beach or hang out in that town. I could be wrong, but I just see so many problems with cruises. If COVID doesn't go all the way away, which it's not, I don't know that it's the preferred way to travel for millennials as they get into their heavy travel years. I just don't see it. And I think now that the boomers are afraid of COVID, I don't see all them going back. So yeah, I think the rally's there. I think a lot of REITs are in big trouble. I think that rents are going to come down because of building. I think that industrial real estate is going to be an outlier to the positive side. I think storage probably flattens out. So industrial real estate is really what I like. I like a handful of the strip mall guys because they have good land underneath their buildings, and their buildings are really easy to change. So I think it's tough. Are tobacco companies the natural acquirers of cannabis? No, not even a little bit. Not even a little bit. You want the pure plays there. Just like Tesla took off, you want the pure plays in cannabis. All right, I'm done. Go Pack Go. And I think we are closer to the end of the bear market that's about to start than people think. Once the large caps and the mega caps especially come down, then it's just a matter of, do we see panic selling in the indexes? Because we know the old men are going to panic, but will the indexers panic? We'll see. I don't think so. Not a lot, a little bit. All right, take care, everybody, and a lot coming out. I'm going to put out my dividend dozen, and I'm going to break up the plug and play into kind of pods and do articles on them so that you can get a little bit more information. All right, take care.